The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, the stock market is a living, breathing entity, constantly shifting and evolving. One moment, it's soaring to new heights, driven by the fervor of growth stocks and tech innovations. The next, it's in the midst of a rotation where the winds of change sweep through sectors, leaving investors scrambling to adjust their portfolios. In times like this, the market doesn't just go through a typical cycle. It's like a storm that rearranges everything in its path, forcing investors to reimagine their strategies. Now, investing during a stock market rotation is like navigating a turbulent sea. So are we currently in a stock market rotation, and what should investors take note of? Well, to find out more, joining me now is Aston, who is a portfolio manager and managing director at Neuberger Berman. Jay, welcome to the show.
Thank you for having me.
All right, Jay, U.S. equities fell last month with consumer cyclical stocks leading the decline, down 4%, driven by falls in sector heavyweights like Tesla and Amazon. And commentators seeking to explain this fall have gravitated toward weak housing data and consumer sentiment. But are we at a stock market rotation here, Jay?
It's impossible to know. Certainly, the distortions in the broad indexes with regard to the concentration, the Mag 7, and the high valuations associated with those could ultimately lead to a corrective phase, but it's impossible to know exactly, Hongbin, how that will play itself out. It could be a matter of a number of the constituents of the Mag 7 just taking time to grow into their valuations. It may be a matter of certain of the Magnificent 7 not living up to the growth implied in their valuations. Or, as you point out, it could be a broad market correction that brings down valuations across those. But certainly the distortions that have been created by the Mag 7 are certainly cause for some concern.
I see. Well, you mentioned there it's impossible to know whether we're at a stock market rotation, but are there any signs of a stock market rotation?
Well, as you point out, you do have certain of what have been the leaders down a bit more year to date. You also, if you look around the world, have signs that the S&P 500 and the U.S. market has really been the leader for a few years. You see at the moment MSCI World outperforming S&P, and so you maybe do have some change in leadership, but again, it's really too early to know.
I see. Well, if we certainly are in a rotation here, and if that were to continue and headline returns, could become negative, at least in the short term, how should investors respond then?
Yeah, so it's a great question. And frankly, our investment process, the way we invest, is really designed to invest through the cycles. We're big believers that timing market cycles or timing economic cycles is next to impossible. And so having an investment framework that allows one to have some visibility and predictability and invest through the cycles is exactly why we invest the way we do. We take a top-down and then a bottom-up approach to identifying investments, and quite frankly, it's during periods of turbulence that we find some of the greatest opportunities. But so our goal is not to time the market and attempt to call the market, but it's much more having a consistent process that guides us through both up markets and down markets.
I see. Well, on that note, what's the overall outlook for U.S. markets in your opinion?
Again, if you ask me, if I think the market's going to be up, down, or sideways over the next 12 to 18 months, I'm going to tell you I don't know. And again, that comes back to acknowledging that calling markets next to impossible. And what we've found over time to be much more predictable is really having an investment process that allows one to invest through a number of different environments. There's obviously a tremendous amount of geopolitical concern in the world at the moment. There's concern about the regime change in Washington and new policies coming out of the new regime. And certainly when you have a new administration come in that has some significant policy changes, it creates uncertainty, and markets hate uncertainty. But having said that, it may just be a period of where markets just adjusting to that near-term uncertainty. And as policy clarity comes through, markets may stabilize some. But again, calling it is next to impossible. And so for us, it's much more about having a framework that allows us to invest irrespective of whether the market's up, down, or sideways over the next 12 to 18 months.
I see. Well, zooming in a little bit here, how much are tech stocks then impacting the movement of U.S. equities at the moment?
As they, again, have been certainly the leadership group, large cap tech, and as the Magnificent Seven represent roughly 30% weighting of the S&P 500, their movement is absolutely going to have a pretty meaningful impact up or down on the broader indexes.
I see. Well, on that note, what metrics or factors should an investor, consider when determining if a tech company's stock is overvalued or even undervalued? Do you think that these metrics are sufficient for, say, AI enablers, or are there new factors to consider?
When we're evaluating a business, we have found that the highest correlation with equity value appreciation is growth in cash flow, and particularly free cash flow per share. And so we evaluate each and every business that we look at, whether it's a tech company, otherwise really based on forward cash flow and free cash flow metrics. And we think, again, whether it's a tech company or any other company, for us, that's the best way to measure a company. One has to look out over a 3, 4, or 5 year period, make their best assessment of what the cash flow and free cash flow potential of that business is, and then make a judgment as to what an appropriate valuation is.
I see. Well, then, what are the risks associated with placing too much emphasis on the top tech mega caps like, Apple, Microsoft, and Apple when it comes to AI growth?
I think there's really an important distinction to be made between great businesses and great investments. When we look at the Magnificent Seven, one could easily embrace the idea that each of these businesses have been leaders and very likely will continue to be leaders in the most rapid areas of growth, particularly, as you point out, related to AI. But just because they're great businesses doesn't necessarily make them great investments from here. So going back to my point about how one values a business, one has to take great businesses, but then also say, based on what the forward potential value of this business is this a great investment from here? So that's the lens we would encourage investors to look through when they consider, where to go from here.
I see. Well, then what indicators or events could signal a potential correction in the valuation of AI enablers or tech mega caps, and how can investors best position themselves ahead of this?
Well, I think a technical correction is 10% or more in a stock price. And so I think that would be kind of the technical definition. Again, it's really, as I said at the outset, in our opinion, it's impossible to call the next turn in the market or the next turn in the price of an individual security. And instead, one has to step back and really take a much longer term point of view and look at a business and say, is this business, the value of this business, a compelling investment from here? And then accept the fact that there may be factors like geopolitics, like anxieties, unrelated to the fundamentals of an individual business that may have a short-term impact on the stock price movement. But want investors really to prepare themselves should look at each and every business that they own shares of and say, is this an appropriate value for this business?
I see. Well, circling back here, even though we don't know for certain that we're currently in a stock market rotation, but it looks like the out-of-favor U.S. stocks are currently getting attention here. Other than tech, what out-of-favor U.S. stocks or sectors are showing benefits, and what other sectors or stocks can investors consider during this time?
So I think we've spoke a bit about the distortions created by certain parts of the market that might be fully valued. There's a tendency to think that there's opportunity companies that have lower valuations. We'd caution investors with respect to value traps. So there are certain businesses that have a lower valuation where the prospects or outlook for those particular businesses are not very good. And so it's important when one looks across businesses or sectors, look for businesses that have visible, predictable growth, whether that's high growth or low growth, but also look for businesses that have the capacity to grow their cash flow and free cash flow per share meaningfully more than what's implied in the stock price today. And so I would not necessarily focus on individual sectors, but in more so take that lens to evaluating where the opportunities might lie.
I see. Are there any non-U.S. markets also benefiting at the moment? I mean, what other regions are also showing opportunities?
We take a really global approach to investing. We're agnostic to where we find ideas. We're really looking for the best ideas in the way of the big ideas. And so, we're finding opportunities in Europe as well as Asia. And one of our best performing investments last year happened to be in Latin America. And so we're really finding opportunities around the world.
I see. And before we let you go here, Jay, what else will you be tracking in the coming weeks that could move markets?
So we acknowledge that this geopolitical anxiety or tension around the world and change of administration has brought some uncertainty. And new policies are still rippling through kind of the realities of the forward economy. But for us, we come back to the fundamentals of each and every company that we evaluate for investment. Look for, as I was saying, kind of the prospects for growth in their business, the prospects for free cash flow growth in their business, and really look at those metrics to determine, where the best opportunities are. It's our opinion that there is a lot of potential growth, not only in the U.S., but around the world. We certainly are big believers that the efficiency gains that are being brought by technology advancements are going to lead to tremendous productivity. So we're quite constructive and on kind of global growth, and we just are very particular about the types of businesses that we want to own.
I see. Well, thank you so much, Jay, for your time and your insights today.
Thank you.
That was Jay Aston, who is the portfolio manager and managing director at Neuberger Berman. And this has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.